So what we wanted to do is, if you've participated in any of our previous webinars, and by the way, this is, I think, number 6 for the year. We are really trying to make our content available to all of our clients, all of our listeners out there, anyone who's just even maybe wanting to see what does CandorPath do and what are some of our areas of expertise. Of course, one of those areas here is taxation. Now, we just got finished. We are the tax team. We just got finished completing a really successful 2024 tax season. And boy, there's nothing more that we want to talk about is more taxes. But so what we figured we would do, and Mackenzie and Rain and the rest of the team here decided to make this into a little bit of a fun trivia session for our clients that are listening here today. So for those of you that are doing this live here, Mackenzie's going to give you instructions here in a moment. If you're doing this on recording, you're listening to this after the fact, that's also okay. The questions are really just meant to be for us an area of talking points. These are questions that we specifically picked on to talk about areas that occurred this tax planning season that we want to make sure everyone is aware of. These might have been problem areas. This might have been area of focus. And so these are questions that we specifically picked. At the end of this, we will ask the audience for any additional questions that maybe something is just burning in their minds and they want a quick answer on. And then, of course, we will provide an opportunity for anyone to kind of book a quick call with us and maybe do something one-on-one. So we're going to go with this format here today. Of course, I am joined by my tax team member here, Mackindsay Herbert, who is my right hand when it comes to us accomplishing all of our tax planning here within the firm and go. So I'm going to turn this now over to Mackenzie. Mackenzie, how are we going to set up today's format and where do we go from here?
Yeah, thank you, Matt. Okay, so this is going to be trivia, tax trivia. So we are going to post several questions for you guys. And for each question, there's going to be a pop-up window that pops up on your screen for you to answer. We'll give you a couple seconds to go through the answers and choose the one that you think is right. But throughout each slide, if you guys have any questions, like Matt mentioned, just throw them in the chat box and I'll do my best to keep an eye on those and we'll try to get through all of them and answer them at the end or throughout the tax trivia. So with that being said, let's
roll with number 1 here. So question number 1, again, these were all chosen by us to just talk about a specific point, maybe something that we saw that happened throughout the tax season that was impactful or that was a problem. And we're going to go with question number 1 here. Mackenzie, what is question 1?
Yeah, so this was a key topic from this recent tax season. It's IP PIN, or an identity protection PIN. What is the purpose of this? What does it do? So A, we have it prevents someone from e-filing a tax return using your social security number. B, it gives access to IRS refund tracking. C, it lasts for life once requested. Or D, it's used to verify your income.
Yeah, so you just saw your poll come up there on your screen. If you're watching this, we're already seeing some of our folks here enter it. And just while that's going on, I want to give some context to it because it's one thing to answer the question. It's a whole nother thing to talk about why this is important. So just so you know, and this might tip your hat to the answer here today, but when we file your tax returns, we get an automatic notification from the IRS whether it was accepted or whether it was rejected. And this year, as Mackenzie and I were pouring through the nearly 200 tax returns that we do here at the office, seeing those rejections come back, and a lot of those rejections had to do with this question, an IP PIN. So we're going to get to the answer here in a second. I think we got everyone who put a right answer. Let's see that answer here.
Hey,
amazing.
So it
Yes.
prevents someone from e-filing a tax return using your social security number.
Yeah. So, all right, we got mostly everyone who got it right. And why was this important was because this year, and this has been occurring for a number of years now, this IP PIN is the ability for the taxpayer to either be assigned this by the IRS or to go out and get an IP PIN by logging onto irs.gov. And what this allows you to do is, in order to file your tax return, we must have this PIN number. If we try to file it, it gets rejected. And the reason why this is so incredibly important is that there's scammers out there who will try to file a return on your behalf and request a massive refund. Now, you don't know this is happening. This really doesn't have an impact on you until you go to file your own tax return. And we get the rejection stating that someone's filed this return already based using your social security number. And that causes a whole bunch of cascading effects to occur. We have to then paper file. We have to kind of argue with the IRS. We have to provide additional identification. So they created this PIN number for some of our taxpayers that allow them to, again, go out to the website, download that PIN number, provide it to us, or enter it into TurboTax if you're doing this on your own. And that's the only way you can file. Now, how many digits is that number, Mackenzie?
It is a 6-digit number. But with all that being said, Matt, there is a caveat to it, and we actually have a bonus question here. We don't have a pop-up for this, but if you want to answer this question, just throw the answer in the chat bar. But how often must this be renewed if you have an IP pen?
Yeah, and this caught a lot of people by surprise because they went out and they said, okay, I got an IP pin. Great. Guys, here's that number. We go to file the return and we get another rejection. Why do we get that rejection? Because this pin must be renewed annually.
Annually.
Oh, what a pain. That means logging back on to irs.gov, going through the entire process, obtaining that PIN number, getting a new number for this year, and doing so. Again, great protection piece. It is a royal pain in the tush to do, but it's less work than having to argue with the IRS because someone filed a return on your behalf and used your social security number. All right. All right.
Yeah,
So I feel like I got the first question jitters out of the way. Mackenzie, what do we got?
Yeah, so our next question, number 2, why might someone owe a large tax bill or receive a big refund? We have A, not enough taxes withheld from income, B, life events such as job change, side income, etc., C, no estimated payments being made, or D, all of the above.
And as you're clicking that pull box there and trying to come up with the answer, yeah, I'm starting to see some people are catching on here. Some of these questions are going to be pretty easy, but it's more of the intent behind it. Is again, there should be no surprise or very little surprise when it comes to filing your return in April, right? All of the planning should be done throughout the year. And again, making sure that you're withholding enough, making sure you're making an estimated payment if you don't have a source that withholding takes place on, such as your job or from an IRA distribution, or something major occurred in your life. A company paid out stock. You lost a job or gained a job. Your spouse started working. There's so many things that speaking with us throughout that year is incredibly important so that you don't get to the end and have a surprise. We hate surprises, especially as planners. All right, so what's our answer here?
Answer is all of the above, which I think you just kind of covered in your little explainer there while we were answering the question.
I hate dead air, Mackenzie, so I'm going to have to talk anytime there's dead air. So just know that that's happening. All right, here we go. Number 3.
So number 3, you can deduct medical expenses if they exceed what percentage of your AGI, which is your adjusted gross income. We have A, 2%, B, 7.5%, C, 10%, and D, 12.5%.
Boy, there's nothing Mackenzie loves more than getting a stack of receipts for medical expenses when we go to file your return. Mackenzie, on a scale of 1 to 10, how excited are you when we get a big stack of medical receipts? Is that your favorite thing?
I won't say it's my favorite to go through and sift through a bunch of receipts, but I can understand the importance of them if it's something that we can use to itemize their return.
Yeah, so let's explain this a little bit here because we're seeing these poll numbers come in. But remember the entire process of deductions. You get a number of deductions that you could potentially take. And those deductions are all totaled up on your Schedule A called your itemized deductions. Now, in most cases, our clients take the standard deduction because between charitable giving, interest paid, and medical expenses, they have to total a fairly large number these days. That number has been growing and grows each year. But the kicker with medical is that in order for you to have a medical deduction, it must exceed a certain percentage of your adjusted gross income. So again, just taking a look at these numbers, let's say hypothetically your adjusted gross income is $100,000, just to keep math easy. And you have to choose one of these numbers on our screen here. Let's just say you happen to randomly choose, let's say B, for instance, and it's 7.5%. That means the first $7,500 of medical deductions are not included in your itemized deduction, but any amount over that is. And you have to take those numbers along with any interest and taxes paid or charitable giving to see if that then exceeds the standard deduction. So while we love getting your medical receipts and Mackenzie loves sifting through those, in most instances, unless there is an anomaly or something enormous that occurred, which does happen from time to time, in most instances, a medical deduction is not often taken. And that's because the answer to our question here is
B, 7.5%.
All right.
All right, so let's move on to question number 4 here. Which of the following is eligible for the dependent care credit? A, paying for your daycare for your 3-year-old, sending your child to overnight summer camp, C, paying for your child's school supplies, or D, hiring a tutor for your high schooler.
All right, so you're a dual income house. Both spouses work. You have a child. of an age that's below a certain age limit, and you have that child goes to you have expenses. Like, gosh, I can't give the answer away. It's so hard to even talk about this without giving the answer away. But you have some expenses. What expenses can be offset by a tax credit for dependent care? So again, a couple things to consider. Again, I just mentioned must be dual income. So if one spouse stays home, that doesn't really apply. Also, if you have a dependent care credit at work, this number will oftentimes offset that number. So we can't really kind of double dip into that category. But if we kind of show our answer here, Mackenzie, what are we at?
Yeah, so it's A, paying for daycare for your 3-year-old.
All right. And again, my mom is not listening today, but she's worked in childcare her entire career. She calls it childcare because they don't take care of the day, they take care of the child. But yes, the paying for childcare for your 3-year-old would be an example of our dependent care credit. Now, how do we actually take that credit? Mackenzie, what's the information we need in order to accurately put that on a tax return and take this very valuable credit?
Yeah, so typically when you have your daycare for your child, they will produce an invoice for you showing the amount that you've paid. And on that invoice, it's really important that showing their EIN or their TIN, their taxpayer identification number, and their address and the total amount that you paid for that tax year. So that's all the information that we need. So if you know that you have daycare for your child and you know that you could get this credit, it's really important to make sure that you upload that information with it.
Absolutely. Yeah, great point. And it's sometimes it's weird to ask somebody for their tax identification number, but these childcare centers are aware of how the credit works, and they'll oftentimes put that on the invoice. So it's not an awkward conversation of like, hey, I need your social security number so I can get a credit. Again, it's oftentimes put right on that form. And once we get
Yeah.
that, we're able to enter it into our system and make sure we
Yeah.
take the proper credit.
Yeah, that's great. All right, next question. When should you review your tax pro forma or projected tax return? A, only at tax time, B, mid-year, C, before year end, or D, both mid-year and before year end?
I mean, this one's pretty obvious, I think. There's never one point in time. Oh, there we go. I'm watching the poll go live and seeing everyone just
Yeah,
click on it really quickly. But yeah,
yeah.
I mean, this one is so incredibly important. There's so much that changes throughout your life throughout the year that impacts
Mhm.
taxes. Again, it's never just one look at it. We like to have multiple looks at it. And
Yeah.
yes, of course, the answer here, Mackenzie, is
D, both
yeah.
mid-year and before year end. And like Matt said, we love to look at it multiple times throughout the year for our tax clients specifically. I'm sure they're where we send out emails to them throughout the year, wanting to follow up and do tax pro forma. So that way we know come tax time, there's not like this big surprise of what the bottom line is. So
Yeah, and I think if we take a look at those two like times of the year that we like to do that is typically we like to take a look mid-year in June. We've now gone 6 months. What did the first 6 months look like? What do we predict the next 6 months looks like? And if we're off by a lot, we really have until April of the following year to at least start building cash to pay a large tax bill if it was a one-off event. The second time we like to look at it is kind of like near October-ish. Still gives us about 5 months before we actually have to pay that bill. And it kind of
yeah,
covers that second half of the year.
yeah, for sure. All right, next question, number 6. What is one benefit of estimated tax payments? So we have A, they increase your refund. B, they reduce your taxable income. C, they help avoid penalties for underpayment. Or D, they increase Social Security benefits.
All right. So this is also not an option. Like you don't say like, you know what? I think I actually want to make estimated tax payments. Estimated tax payments are due when you expect to owe more than $1,000 to the IRS. Now, you have to have basically 2 consecutive years of that to happen in order for them to start assessing you with penalties and interest for not making estimated tax payments. But
Yeah.
we want to make sure to spread this bill out over the year. And in fact, you don't really get an option to do so. So the IRS says, we do want money from you. We do recommend you make some estimated payments. And we want to do so to avoid, have we gotten all of our answers in? Reduce taxable income. Who said reduce
More, but
taxable income? Well, we're going to have some tax training for some of our clients here.
yeah, our answer is C, they help avoid penalties for underpayment.
Yeah. So IRS wants their money every 90 days. They don't want you really writing that large check in April. They want every 90 days, but they have their own 90-day schedule. It's not actually even 90 days. It's kind of this wonky schedule of random, what appears to be random times. What does that schedule look like right now, Mackenzie?
Yeah, so the IRS likes their payments quarterly, so they like their payments to go out in April, June, September, and January of the next tax year.
Yeah, and they choose the 15th day of each one of those months. And if you
Yeah.
skip one of those, they start to accrue penalties and interest, which is not a generally large sum of money, but still we're trying to just pay the amount that we owe and try to avoid any of those types of penalties. But they want their
Yeah.
money again in those 4 specific time periods. Again, that last one is January 15th of the following year is that last estimated tax payment. We sometimes use that as our final one to make the adjustments up or down so that again we avoid as penalties as much as possible. But it's not an option. You don't have an option to do it. It's something you really should be doing. Again, if you expect to owe more than $1,000. And again, this not only applies to the IRS, but also applies to your state government if you have state tax. I'm looking at our list here and I see some clients that are outside the state of Florida. And so that's one that we will always address as we do our tax planning is to make sure you're making proper estimated tax payments. All right.
Yeah,
Well, I
and
think
one
we're
thing I
ahead of
wanted
schedule right now.
we are, but I'm going to back up really quick because one thing I wanted to make sure to note for the estimated tax payment specifically is if you forget to do one or you skipped 1 month, don't like let that discourage you because you can still make up for it the next quarter payment that they want you to make it. Like Matt said, if you don't do it, sometimes there is a small penalty for that, but don't feel like that means you just can't do it at all for the next time that it's due. So don't let
Oh,
that
I got a good
discourage you.
question, Mackenzie. How is the best way to make estimated tax payments? One thing to say you have to do it. What are kind of like the two ways that we normally see clients do it?
I'd say the two common ways that we see them do it is they can either mail a check to the IRS with a payment voucher. If you're one of our tax clients, we have that payment voucher that we can send to you to mail your check with, or you can go onto irs.gov direct pay and you can put in the information to make your estimated tax payment online, which is, I feel like, probably the most easiest and convenient way to do that. So
Yeah, tracking a check and make sure it gets received and then making sure that check got deposited and IRS maybe saying they never received it. I know a lot of clients sometimes are leery about having the IRS making a withdrawal out of their checking account. I can assure you that it's a very normal process and there's nothing really too much to be concerned about. And honestly, it's probably safer than having a check out there and not being able to track it. But yeah, our direct pay is a great way. It's the way we pay our taxes. But you can also have a check and with the voucher, making sure your social security number's on it. And we will have those vouchers for each one of our clients, depending on how they want to make that estimated tax payment. So, yep. Good.
All right, next question. Which of the following natural disaster expenses may qualify as a tax deduction for Florida residents? This one kind of hits close to home, but we have A, hotel stays after evacuation, B, casualty losses not reimbursed by insurance, C, emergency food supplies, or D, gasoline purchases.
I mean, us here in Florida are not. I mean, and really, it's not just Florida. Between our hurricane season, the hurricanes that impacted the Carolinas, what we saw the fires out in California. I'm sure there's something also bad happening in the Northeast. But wherever we are having these natural disasters, and what's very important here is the IRS actually declares whether it's a natural disaster or not from a tax standpoint. So, for instance, those hurricanes that impacted the Carolinas and all that flooding, they deem that as a natural disaster. They actually have a code for that actual situation. And when we go to file these returns, we want to make sure that we're letting the IRS know that the taxpayer was impacted by this specific natural disaster and that there is a reimbursement there potentially. We'll see what the answer looks like here, but there we go.
Yeah, so casualty loss is not reimbursed by insurance. So if you had damage done to your home or anything like that, you had to replace your roof, as long as the insurance covered that, we can't deduct that. So if it's something that you paid out of pocket, you didn't get reimbursed for, then we can go ahead and claim that deduction on your return. But if the insurance stepped in, then hands are tied.
Yeah, and again, it sort of makes sense. If you're being reimbursed by insurance, there was no really out of pocket on yours, but the amount that was, out of your own pocket, that is potentially, again, depending on the natural disaster, it's a large caveat there, is depending on the natural disaster and what the IRS, how the IRS wants to handle it, that casualty loss becomes an itemized deduction for you in some instances. In other instances, it just appears as a deduction right off the return. And
Yeah.
again, the ability for us to maybe get a little more help for some of our clients that were impacted by natural disaster.
Yeah, definitely. All right, next question, number 8. What form of income allows for deduction of related expenses like mileage, home office, or supplies? We have A, W-2 wages, B, self-employment income, C, unemployment compensation, or D, Social Security.
I'm like a professional test taker with all of the licenses we've all had to deal with. I mean, I think you can kind of easily knock out 2 of them right here with C and D, because with unemployment compensation, you're technically not working. And Social Security, you've already worked, and now you are on the other end of the work life and are now enjoying, hopefully, retirement. So it kind of boils down to 2 answers there, either A or B. And what might trip some people up is so many people are working for companies that they work from their home, and or they have remote offices, and so there are additional expenses maybe for setting up their home office. But can those actually be deducted? Well, we're about to find out.
B, self-employment income.
Self-employment income. But again, there was a point in time many years ago that as an itemized deduction, you could take your professional expenses, even if you were a W-2 employee. But as this answer alludes to, only those that have self-employment income can actually write off expenses against that income. And I think Mackenzie's just going to say this, and you can jump in, Mackenzie, that the list is much more broad than these 3 topics.
Yeah, this is just a small example of like some of the deductions that you can take for your self-employment income and the expenses that you have. A lot of our self-employment tax clients, they probably know this. We have a list that we send them of that. If any of their expenses throughout the year like fit into those categories, they can provide that to us. But this is just a small number of those expenses. So
fantastic. All right, moving right along here. Number 9.
This is true or false. You can adjust your withholding on retirement account distributions just like you would a W-2 job.
All right. So you have retirement distributions from your IRA. You're taking distributions out. Maybe it's a monthly, maybe it's quarterly, maybe it's just whenever you need the money. Can we withhold taxes on those, or do you just pay all the taxes there at the end? Good question.
Looks like we still have a few people answering. We're catching up. I feel like most of our clients specifically, I hope it's a little bit obvious. I don't want to assume, but with our clients that have their retirement accounts, most of them, they have their RMDs, the required minimum distributions we have to do every year. And with that, we're always reaching out to them to verify tax withholding on those. And that plays a huge role in our tax planning too side of things. So calculating how much we want to withhold there to help with the tax bill in April.
All right. Answer.
So, true. Most retirement distributions allow you to elect a withholding amount for taxes.
Absolutely. And again, really important to make sure you don't get a surprise, especially in those retirement years where you're trying to have predictable cash flow. We want to make sure that before that money hits your checking account, we paid a tax bill on it. That way, you know what you can spend, and you don't have a tax bill in April that you're like, okay, how do I now pay that bill? And we have to only take from an IRA account, and really kind of exacerbates the problem of having excess distributions from your retirement account. So again, really important planning technique that we use here, making sure your withholding is correct on your retirement account distributions.
Yeah, definitely. All right, last question, but definitely not least. What is the 2025 contribution limit for a traditional or Roth IRA under the age of 50? So we have A, 5,000, B, 6,000, C, 6,500, or D, 7,000.
Oh boy, this one, the numbers are this is like a continuing education question where they put the answers really close proximity to each other. I don't know, did you do this or did Raina do this? Someone put these numbers in really close proximity.
Yeah, it was a dual effort. We both talked through them together. So
got it. Oh, and we're seeing this on the poll. I think we're finally tripping up. Wow, we have I think for the first time with these questions, I think we finally tripped up some people. And here's the good thing. You don't really need to memorize this. This is our job to make sure we have the right numbers here. And the other caveat that I'll make is these numbers change just about every single year. So having them memorized really doesn't serve a huge purpose. Let's see the answer there.
Answer is D, 7,000. But we have a little
Reach.
note under here for 2025. The IRA limits 7,000 for individuals under 50, but 8,000 for those that are 50 and older.
Yeah. So again, you need to have earned income. You need to have a income that is below a certain threshold. Again, that number changes every year. And then depending whether you are allowed to have a 401k at your company, that also impacts that number. And then whatever's left over, the ability for us to do an IRA contribution, further reinforce that retirement savings, make sure you got all the right things and moving all the right pieces for retirement. All right. So that was 10 questions that we figured would be a good one. Now, what we want to make sure is we left plenty of time here for is to answer some questions from our audience. So again, we have that chat box there. Mackenzie will direct you on how to do that. Let's see some questions that come from the audience, and we can just kind of shoot off some of these right off the top of our heads.
Yeah, Matt, we actually have a few good ones here. Let me go ahead and pop those open. All right. So the first one we've got is, Matt, I get paid through restricted stock units. How are those taxed?
Restricted stock units. So your company pays you via W-2. You get your normal salary, and they say, hey, we want to incentivize you. We're going to give you small little pieces of stock of our company, and that's going to be a second form of compensation. So restricted stock units, and they're very popular, especially in the tech industry. And, you know, again, in most situations, it's a public company. There are some situations that it's a private company and they have shares of stock that they'll grant to you. But there's two real important distinctions here when it comes to restricted stock units. There's two important terms. The first is the grant date, or the grant amount, or the grant. The second is the vesting schedule. So when you are granted, that's when you are receiving these shares of stock. You receive the moment that they're granted, you still can't do anything with them. You don't really tangibly own them because you have to wait for the second piece of this, which is the vesting schedule. And the vesting schedule might be, you know, 25% of them vest each year for the next 4 years. So there's all these different types of vesting schedules. And again, a company's trying to keep you as an employee. They're going to kind of dangle that carrot in front of you. If you leave the company, you lose whatever is not vested. But the question comes is how does the taxation work? And the taxation on restricted stock units comes at the moment that they vest. It makes planning pretty difficult because you're granted those units, and we kind of look at those grants and say, all right, here's what's going to come down the road. But remember, they're based upon the stock price of the company, which, as we all know, is a fluctuating number. So they might be granted on this day. They don't vest till this day. And at the moment of vesting, that's when they'll actually become taxable to you. And the way the taxes work on restricted stock units is that they flow through your W-2 and are taxed at your ordinary income rate the moment that they vest. You then have the opportunity to either sell the shares at that point, or you can continue to hold the shares even longer. And at that point in time, you will have both the ordinary income tax the moment that they vest, and either a capital gain or capital loss, depending on how long you hold those shares for after they vest. So great question here. Restricted stock units, they're a big part of our planning aspect for our clients, but one that oftentimes trips people up because of the not knowing the different terms and when the actual tax impact takes place.
Yeah, that was a beautiful answer. Next, yeah, you're welcome. Next question we have is, I'm interested in doing a backdoor Roth. How would that impact my taxes?
Great question here. It's a kind of a buzzword that's happening right now, is a backdoor Roth. Why would we even need to do a backdoor Roth? And the reason why we would do a backdoor Roth is we want to shore up that retirement savings, but we make too much money to do a Roth IRA traditional contribution. So because of the IRS and how complex the tax code is, they created this little loophole which states you can make a non-deductible IRA contribution. That's an IRA contribution you don't take a single deduction for. And at the moment you make that contribution, you can actually then immediately convert that over to a Roth. And there are no income limits when you do a Roth conversion. So you bypass the income limits by using this sort of backdoor technique. A couple of things to just be very cautious of is that you really should not have another IRA with an account balance out there when you're doing a backdoor Roth. Because what happens is, and you might have heard this, is what's called the pro rata rule takes place. And when you do that conversion, you actually might have some taxes due on a non-deductible contribution, which is not ideal. So you want to just be careful on how you do this, but it's a great planning technique. It's one that has a lot of caveats. You want to make sure it's done correctly. The other piece is, when can it be done? And the deadline to do so is December 31st of that year. It's not like a traditional IRA contribution that can be done during tax time. It has to be done before December 31st. So backdoor Roths
Yeah.
are really important, good planning technique, but got to make sure they're done correctly.
Yeah, that was a good reminder throwing in that date there, because it's not the same as doing a IRA contribution. All right, next question. I think this one kind of came from when we were touching a little bit on the itemized deductions we could take, but somebody wants to know, what is the difference between doing a QCD or an itemized charitable donation?
Okay, so QCD, for those that might not know what that term means, is a qualified charitable distribution. In fact, this is, I mentioned, our 6th webinar. I think webinar number 4 this year, 2 webinars ago, was all about QCDs. And it's fantastic for our retirees who are both making required minimum distributions. That means they're over the age of 70, usually 71, 72, 73 or older, and that they're charitably inclined. So the reason why you would do a qualified charitable distribution as opposed to writing a check from your checking account and participating in a 501c3 and contributing is that if you don't itemize. With using a QCD, which is really just a distribution out of your retirement account that goes directly to a charity, you are able to take a deduction above the line. You don't need to itemize to take that deduction. And that has a compounding effect on your income. Maybe it reduces your Social Security inclusion. I mean, there's a number of things that make it very, very attractive. But just like every other thing that we talk about here, there are some very specific rules on how that needs to be done. And if you don't follow those rules, all of it can be done incorrectly and be disqualified. So again, just important to talk with your tax advisor and your financial planner to make sure that if you are going to do a QCD, that it's done correctly. And there still might be some that do make a traditional qualified, a traditional deductible to a charity in you itemize, and there still is a rationale to do that as well. But for a lot of our clients, they find it's incredibly easy to make those charitable contributions directly out of the retirement accounts, assuming that they're making required minimum distributions.
Yeah, for sure. All right, next question is regarding a gift tax return. It says, I made a gift to a family member. Are there any taxes associated with this?
Great question. We get this question so often. The ability to pass money between non-spouses is really kind of what this question boils down to, is if you're going to pass money to someone who is a non-spouse, you have a limit on how much that can be. And this year, as we're doing this particular webinar, it's $18,000, right? So I can give Mackenzie $18,000. No issues with that. I don't get a tax deduction for giving that to her, and she doesn't have to claim any taxable income for receiving that. But what happens if I gave her $20,000? Well, now we have to disclose this to the IRS. Now, the unique thing about a gift tax is that there still is no actual tax that's due. Mackenzie's still going to receive that $20,000, and I'm still going to give her that $20,000, and there's no taxes on either one of our ends. But what this does impact is the donor. Me giving the money to Mackenzie, I have given her $2,000 more than what the current gap tax limits are, or gift tax limit is. By doing so, I have to file a gift tax return. And gift tax returns are filed using tax form
709, I believe, right?
I think it's 706. Either way, it's tax form 706, but you were super close. 6 and 9 are really close together. I get them confused as well. So using tax form 706, we are disclosing to the IRS that I gave someone a little bit more than what the exemption amount was. By doing so, this reduces my unified credit. And it's not a subject we talk about too much, but I can die in this year. What is the unified credit for 2025? I think it's 12 or $13 million. I can die with that amount of money and not pay a estate tax on that. But if I start giving out tax gifts above my unified credit, more than the 18,000 or 19,000, whatever that gift tax number is, then I start to reduce my unified credit each year. And as that number comes down, I get to a point where it's zero. And now I will have a taxable estate when I die. My point for this is that it doesn't really impact most people because of how high the estate tax exemption is. But we still must file the proper forms using tax form 706 and make sure that we are able to disclose to the IRS a gift that was more than whatever the exemption was that particular year. And again, I'm looking at our list here. I can see a few people on here who did give gifts to a son or to a daughter that was more than that amount. We just filed a 706. Let the IRS know that. Doesn't really have a true impact on the return, not unless they change that unified credit and that estate tax deduction down the road.
Yeah, definitely. Love that. All right. Last question. It's a really good one too. I have an account overseas. Do I have to report that to the IRS?
All right. So we have accounts in Canada or Australia or India. We have clients that have accounts kind of all over the place. The first thing is to make sure that you are actually paying taxes on your worldwide income if you are a United States citizen. So you might have that checking account or savings account in Canada that's producing some interest. We want to make sure, first of all, that that is being taxed in the United States. We make sure to do that correctly by using the proper exchange rates. The second piece to it is we also need to disclose that we have accounts overseas. Now, the important amount is how much do those accounts need to be in order for us to must file and disclose those to the IRS. Mackenzie, do we know that number?
I know that you know that number.
I love it. That number is $10,000. So if you have an account overseas more than $10,000, we must disclose it. You're not doing anything wrong. You're allowed to have this. It's nothing illegal. Where the problem starts to come in is if we don't disclose it. So we use tax form. All right, you got to get this one right. I know you know this one. Starts
I
with
feel
a
like
one.
I'm gonna get it wrong again. 8607?
You're so close. It's 114. It's the FBAR filing. Mackenzie, come on. We do so many of these. You know this.
I know.
You're so close. Now, 8606 was the other one for the non-deductible IRA. That was for the backdoor Roth. So we have tax form 114, also known as an FBAR filing. And we file the FBAR for our clients who have overseas accounts for more than $10,000. And all we're doing in that form is stating we have an account, it's overseas, it's more than $10,000. In fact, here was the highest value through the entire tax year. And this is what the number looks like, and we are just disclosing it. It's never a problem until you get to a point where you've not disclosed it. And then the IRS starts poking around, and there are some severe tax penalties for not disclosing international accounts. As long as we're doing it on the up and up, there are no issues with it. And it does get a little scary because the FBAR filing has to do with the Financial Crimes Enforcement Network. And the word crime and financial is all in the title there. But again, what they're simply trying to do is stop these offshore accounts that no one is disclosing, no one's paying taxes on, and that there's no true identification on who the owner of those accounts are. The IRS tries to crack down on that. So they just cast a very wide net and say, if you have an international account, we just want to know about it. Tell us the account balance, where is it located? And you're usually good to go at that point. The problem really comes in is if you not disclose it, and then the IRS comes down on you and yells at you, and then we have to yell back at them. So any other questions?
Well, I think that is everything. Those are all the questions, which they were so good. And I just want to say thank you guys so much for joining us for tax trivia. I know taxes can be such a grueling subject, and I know we just got off of tax season, but we just wanted to do something fun for you guys for like answering common questions that we get all the time. But if you have any other tax questions that we didn't cover, feel free to reach out to Matt and I. We are always available to go over that stuff with you guys. But thank you for taking part of your Wednesday to join us for this. But I hope you guys have a great rest of your week.